before I introduce our amazing guest speaker, I just want to ask a couple of questions. All right. So, and the way we're going to respond is everybody's just going to put something in their chat box. Okay. So first thing is, if you've ever had a commercial real estate loan, I want you to put the number 1 in the chat box. If you haven't, I want you to put the number 0 in the chat box. We'll just see where we're at. Okay. Good. A lot more zeros than ones. We have a handful of ones. So kind of gives us an idea, Julie, of where who we're talking with tonight. Okay, now that's commercial real estate loans. Let's look at single family investment properties. Okay, anybody here ever have a single family investment property? This time we're going to do yes is 3, no is 2. If you've had a single family investment property, 3 is the answer. If not, 2 is your answer. All right. Nice. Whole lot of 3s. Okay. All right. Okay. So, and then third and final question is, have you invested in commercial real estate at all, outside of, getting your own loan? All right. So, besides properties that you got a loan on and sponsored yourself, have you invested in any real estate, commercial real estate, like passively, JVs, or any of that? And we're going to say, let's see, what number are we on right now? 5 is a yes, 4 is a no. All right. Started out with a lot of 5s. Now we're getting a lot of 4s. So I'm just going to take a stab saying about 1/3 are saying yes on that one, and about 2/3
yes
are saying no.
No, sorry, I missed that one.
So that one was, have you ever invested in commercial real estate before? And excluding like a deal that you've sponsored or something that you've done yourself. And 5 was a yes, 4 was a no. Just to give give us an idea of where everybody's sitting right now on the numbers. But all right. So that said, I did that just to get an idea of where everybody in the audience is coming from. All right. So tonight I'm going to first I'll give you an idea of what we're going to the roadmap. First hour or so, we're going to talk with Julie Peterson from Old Capital Lending, and roughly at 8 o'clock, we'll wrap up that conversation, and then after that we'll roll into virtual networking. And I'm on Eastern time, so when I give times out, it's going to be Eastern time zone. But just do your little mental math, convert that in your head. But yeah, so roughly an hour talking with Julie. And then after that, roughly an hour from 8 p.m. to 9 p.m. on the East Coast, we'll do virtual networking. Okay. So that's what we're going to look at. Today, we're going to talk about a lot of things, commercial multifamily, kind of an overview of different loan programs. We're going to talk about, what you should do before you call someone like Julie. We'll also answer the question why you need somebody like Julie, and a lot of other things. If you have questions at any time, go ahead and put them in the chat box, and I'll keep track of them. And if there's an opportune time to break the conversation and bring the question in, we'll ask. If not, towards the end there'll be a Q&A. All right. Any questions before we kick it off? All right, and I am recording this, so anyway, so we will be able to send out a link to the recording once this is all done. But so a little introduction, Julie Peterson. Let's see, I've known her. I think we met in Michael Blanc's Slack group. Is that where we met?
Yeah, I think so.
I don't remember. It's been a while. Okay, and what I've really
probably 2 years.
Probably about 2 years. Yeah. I got into the Michael Blanc coaching program over 2.5 years ago, and I don't remember exactly when it was, but long story short, I've known Julie for about 2 years, and I don't think I can, if I had to really think of somebody who I would trust more with information about, multifamily lending, or just the ability to get a multifamily loan across the finish line, I'd be hard pressed to name one person. So that said, Julie, welcome to the welcome, whatever we're
Well,
calling
thank
this.
you.
Yeah.
Yeah,
So,
whatever you call it. Well, I'm here. Thank
Yeah.
you so much. I'm
Yeah.
excited to be here and really a pleasure to spend Martin Luther King Celebration Day with all of you. So thanks so much I know your time is very valuable. So I want to make sure that any information that I provide, you'll be able to take with you and really make sense of it. So again, my name is Julie Peterson. I'm with Old Capital Lending, and we are a premier provider of debt. Now that could be of industrial, could be office, retail, it could be mobile home parks. There are lots of choices when it comes to commercial lending, but we do the majority of our business, probably about 92% of our business is in multifamily. So we have been around for 36 years. We do $1 billion a year in loans. So when people come to us, one of our strengths is that we educate, and the other strength is that we close. And so when you think about, hey, I've been working on trying to get into a deal for a year, you want to go to a place that's not going to screw it up, right? That's going to be able to close, that's not going to retrade. And I know that a lot of you folks are new here. So if there are words that I use like retrade, let me know, because I want to make sure that I give you the right tools so that they give you a good foundation. And if there are questions that you don't get answered tonight, to reach out to me. I put my contact information into the chat box. I love to work with new folks because I feel like if I can get you going in the right direction, you're going to be my client for the rest of your career. So if I can give you all the answers today or, in our next conversation, then you know what, we're going to be doing business for a long time. When we look at financing, I noticed that a lot of you have done single family. And so coming to commercial lending for multifamily has some real particulars. So I really want to share those with you. One of the things that the reason why you would want to know somebody like Julie or Old Capital or somebody that is a broker as opposed to a direct lender is because we work on behalf of you. Some people will say, well, I'm going to go direct. Here's the deal. When you go direct, you're getting a loan that is on retail lending. When you come to a broker, we have wholesale pricing. So you say, well, I don't have to pay an origination fee. Well, you probably do, because they'll put it in and you won't recognize it. So the great thing about working with a broker, just like it would be to go and get a coach when you're lifting weights, or you're going to find out you're trying to build your finances, come to a broker where I can go and talk to a bunch of different lenders and get you the right loan for your application. Really, really important. There are lots to choose from, but we are your biggest lender. We are your biggest partner, I should say, of the deal. We're bringing 70, 80% of the deal. The rest of it, 25%, is coming from your investors. And even more so, only 10% may be coming from your down payment, which is coming from the management team. So you really want to find a banker, a lender, a mortgage broker that you know, like, and trust. And that's what I'm hoping that I can serve you well today and really get you off and running to the races so that when you're building these relationships with your brokers or with your investors, that you really sound smart, because that's really the key to being successful here is you can really fake it if you want to, but getting that information and having a solid base for your clients really does make a difference. So we're going to talk about the options, the various financial
Julie,
options.
let me hop in for a sec real quick and just double down on the point right there. All right. Having an experienced lender or a broker like Julie on your side is huge, because, looking at the numbers, very first, the numbers that we put into the chat box, there were a lot of zeros in there, meaning a lot of you guys haven't had commercial loans before. which means if you want to try to go direct to a bank, you can. But do you know the right questions to ask? Do you know all the potential products? And do you have the clout that $1 billion worth of loans has as far as bargaining power? And I would venture to say that any beginning investor that put a zero in there by themselves is not going to have that. So I would absolutely positively say, you need somebody like Julie Peterson on your team. All right. Julie Peterson's a great person to have on your team, but if not her, you need somebody like Julie Peterson on your team. But anyway, there you go.
So thank you. A little bit about us, about me. I've been in real estate for 30 years. I started my first transaction when I was 22, and I really thought this was it. I'm going. That property in Southern California, I was working for a bicycle company, and my clients who paid my bills, their bike shops, they got looted in the riots. And so I didn't lose my house, but I gave my house to a friend of mine for $4,000, and he made the payments. So I walked away saying, well, I didn't have to pay a landlord, but not really the way I wanted to do it.
Mm-hmm.
Then I moved to the Bay Area, worked for the same company. We doubled our money in real estate there, went to Chicago, had some multifamily in Chicago. And after 11 years, because that was 2008, we were into negative amortization. I had great cash flow, but I was used to being in California where you have a lot of appreciation. You could double your money. I walked away 11 years later with $50,000. So I got up and I got down, I got up and I got down. So remember, real estate is, you have to take the good with the bad. And you have to try, just like stocks, you have to try and hit it at the right times, right? So brought my properties from Chicago over to San Diego. I'm also a limited partner, but I am really done being a landlord after 20 years. So I am selling off my properties here in San Diego and getting into limited partners, and will be getting into GP positions. So I really want to encourage you to understand the whole process. And what I do want to encourage you to do, because a lot of people want to be GPs, and there are ways and things that you need to understand to be a GP. But most importantly, I will tell you, you really should start out as an LP, because what greater information can you understand and receive from another syndicator? Like, when do you talk to your investors? What do you share with them? What is important? What isn't important? Why did you pay this property manager 8% when we agreed on 5%? Some of those things, if you don't have an LP position or experience, you're going to find yourself in a GP position and not communicating correctly. So I really recommend that everybody first get involved with an LP, start underwriting deals, understand what it takes to get into these deals. Not everybody should be a GP. Some people play better as an LP. And as a syndicator, we need LPs. And these deals, they can take, I've got some guys that have been working on this for 2 years, and they're waiting for the right opportunity. But in that 2 years, they're looking for their partners. They're looking for their brokers. They're looking for the right area to buy in. In that time, in that 2 years, maybe they could have been an LP and had their money working for them. So you got to kind of think about, where do you play? What's your lane going to be right now? Mm-hmm. And in that, learning. We should not be becoming GPs unless we have educated ourselves. And as I'm an advisor on the Michael Blanc group, these people are educating themselves. There are other groups where you can get in as an LP. It gives you opportunities to invest, gives you opportunities to learn. I really recommend taking 6 months to a year to really educate yourself, because no one can steal that from you, right? I mean, you can go and have a 4-year degree and still not know what you're doing. But if you're focused in multifamily or in commercial opportunities, get really educated quickly. It'll be worth it in the end. So what I want to talk to you today about, you guys, is what it takes for commercial lending. What are the options? And it's kind of like, I don't know if you've ever heard of In-N-Out Burger, but I'm in San Diego and many of the people on the West Coast have In-N-Out Burger. And you can get all sorts of different options. You can get whole grilled onions, you can get chopped up grilled onions, you can get fresh chopped onions, you can get, I mean, there are lots of opportunities or different choices. That's kind of like how it is in commercial lending. So when you're looking at an opportunity, you have to know what your business plan is. And I bring what my tools are and what the options are available and try and match it to the right product for your business plan. So I work with 4 different types of loans, and we'll go through those real quickly. Now, if you've been in single family, you know about recourse lending. Recourse is bank lending, and I kind of look at it as like the bank puts their hand in your pocket and they take your wallet and they say, thank you, that's mine. And now you can't use that purchasing power for that certain amount of money that you put towards that deal. It's going to restrict you. If you've got kids that are going to college, if you are wanting to buy a house, that's going to hit your balance sheet. So you're not going to have the flexibility on a recourse loan like you would in agency. An agency is Fannie and it's Freddie. But let's talk first about bank lending. So bank lending, typically you're going to be looking at a community bank. So you're looking, most of the time we've got people like yourself looking in areas where maybe first of all, they're looking close by where they live. Now me living in San Diego, I don't want to buy anything here because it's overpriced. I can't get the rents like I would somewhere like Augusta, Georgia. So really start thinking about, okay, where am I going to look? Where makes the most sense? Because you need to look at your team so that maybe there's somebody in your team that has boots on the ground. Because for commercial bank lending, this recourse, they're going to want somebody who has boots on the ground, somebody who has a local presence, and they're going to want you to have a business relationship. So on these commercial local banks, we're going to get you probably about 75% loan to value. That means you're going to bring in 25, I'm going to provide 75. Typically the loan time, the lending, the rate is going to be a little bit higher than your non-recourse. So right now we're between 3 and 3.5 on non-recourse. And I would say you're in the middle to high 4s. So it's quite a bit more. Why is that? Well, because these banks are wanting to make sure that their depositors, who are your aunts and uncles and your grandmas, are protected. So they want to make sure that they have enough money coming back in their loans so that they can protect who their depositors are. We just got a 4%.
Just to add to that, we just got a 4% loan from a regular bank, bridge product. And it is much higher. It is higher. It was also a recourse loan. A lot of people will say don't go recourse, but every once in a while, I think recourse loans make sense for certain properties. But 4% on the dot.
And for Brian, he probably has maybe 5 loans with that bank, maybe.
With that bank, 3.
So a bank is going to say, hey, you're investing in me, I'm going to invest in you. So they're going to say, I have an experience with this client, and I'm going to put my neck out just a little bit. If one of you were going to go into that bank, I guarantee that rate would not be as good as what Brian is getting. So it's kind of one of those things, you invest in me, I'll invest in you, and I'll take care of you. Sometimes if you have a really good relationship, they'll make a small amount of that loan non-recourse. So they do have a little bit of flexibility, but for the most part, it's going to be a little bit more constrained than what you're finding in a non-recourse loan. We would say probably a 5-year loan. How long was yours, Brian?
It was a 5-year
5 years?
loan, and they had some sort of burn off. It was the first time I've heard of it, but it was a burn off of the recourse, where I think after 12 months of making payments, it moves from a recourse loan to a non-recourse loan.
So there you go. There's an example of how they're making sure that their depositors are paid for in that first year, and then they're opening up the doors. Again, that is because Brian and his group have a good relationship. Typically, you'll find a 5-year, and you'll go 20 to 25 years amortization. On the other loans that we're talking about, that's 30 years. So what is the difference? What does it really matter? Well, if you think about it, 20 years versus 30, your payment, your monthly payment for a 5-year loan is going to be higher than a 10-year with 30 years amortization. So the strain on that asset is going to be a little bit more than what you would get with non-recourse. So keep that in mind. What these local banks don't have is they don't have any restrictions on a COVID requirement, which we'll start to talk about. But bank lending, there is a place for it. And for new people, it is a great route. The only struggle is your investors. If much of your capital is coming from investors, a lot of them don't really want, if they're a LP, they really would prefer to have some certainty, and you can have a little bit more certainty when you're going with non-recourse, and non-recourse is going to be longer. So there aren't going to be flexibilities where I want to hold this for 10 years and I only have a 5-year loan. What happens in 5 years? Maybe the interest rates are today at 4, they may be at 8. So now what was profitable for your investors is no longer profitable. So we as syndicators in the syndication model says go for the longest debt, okay? So keep that in mind. And when we're talking about non-recourse, this is the gold standard. This is how all syndicators really want to get to, is this non-recourse. So are there any questions?
I am going to bring
about
one thing
recourse
up. And maybe you can talk to it. It's probably more appropriate in the non-recourse section. But when you say long-term debt, can you talk about? Make sure you talk about prepayment penalties.
Yep.
The step downs, yield maintenance, and
You got it.
how that fits into business plans.
Yeah. And in bank lending, and I talk about this being the commercial local bank, sometimes they have a prepayment, meaning, now remember, single family, you can get a loan and 3 days later sell it like a wholesaler or whatever. There are no prepayment plans. But in commercial lending, especially in multifamily, you got to pay to play to get out of the loan. So in commercial banking for this local lender, sometimes they have a prepayment plan, sometimes they don't. So it just depends on which bank you work with, okay? So that's all about banking for commercial local banks. Recourse. Let's shift to non-recourse. Again, this is the gold standard. Back in 2008, even in the 1990s, who were buying these apartment buildings? People with oil and gas, people that had a lot of money. Well, 2008, we saw that there were people coming in that maybe were doing this syndication model that said that you and I can afford to buy apartments. So back in the early teens, Fannie and Freddie said, hey, we can participate in this and we can allow and provide this non-recourse lending option, which is terrific. So what this means is that instead of someone coming and taking your wallet, and in that case, even though you have an LLC, you are still personally guaranteeing it. When we go to non-recourse, you are signing, but you're not personally guaranteeing it. You have an LLC, it is the entity that buys this property. Now keep in mind, we are in the business to rent you money. We are not in the business to to own these properties and to manage them. So the agencies work really, really hard to make sure that the people that are signing are capable of taking this down. And so there are 4 requirements when we talk about agency debt that you do need to know about. So first, we're looking at properties that are 90% occupied for 90 days. And if you're not taking notes, right now would be the time to start taking notes. These are the details that you need to know when you are saying, hey, I want to get into this. I know these are the agency details, the
And
gold standard.
I'll tell you why this matters. I mean, she already gave you a hint, 90 for 90. We had a property under contract that was right around the 90%, the right 90% mark on occupancy. And we applied for an agency loan on it. But what happened is after we got the property under contract, the occupancy dipped to 80. It dipped to 80%. I mean, it took a nosedive for a couple of weeks, which basically meant the loan that we thought we were going to get was no longer available for us. So these standards, yeah, definitely pay attention, write them down. And
yeah, this is the what's the word? This is what you came to show up for right here. Okay, 90 and 90. So when you're talking to a broker, and by the way, I'm going to give you 3 nuggets today. The first nugget is when you're looking in to getting into an underwriting and figuring out where you want to go. You want to go to a market that you're not interested in buying in because you want to make as many mistakes there and really fail over there so you can make those mistakes and go to the right market where you want to buy. So you can just escape all of your problems and go over. So that's one nugget, really important. And the second nugget, I've got 3 of them. I probably have more than that. But the second nugget is, as Brian said, you want to buy a property and tell that, whether you're in due diligence and you're meeting the people that are that are there, maybe it's the management team, make sure they know to keep their foot on the gas. Because in Brian's case, and I've done 4 days before we're closing, the evicted person moved out and now I'm below the 90 and we almost lost the loan. So it's really important that you communicate with the broker and the broker communicates that everybody needs to keep the foot on the gas until you close. That can be a huge problem. So 90 and 90. The next thing is net worth. You need to have net worth greater than the loan amount. So let's take, for instance, you're going for a $1.4 million deal. And I'm going to give you a loan to 1 million. So it's 75, 80%, your loan amount. And we start these loans at 1 million. So in this case, the sales price 1.4, I'll get you into a loan of $1 million. Your net worth, your own or your group, needs to be 1,000,001 cents. It's got to be greater than the loan amount. Very important. Now you say, well, I don't have any money. I'm using other people's money, right? We all hear about this. From a lender standpoint, we would really like to see you bring some capital to the deal. Not always necessary, but it builds strength of the deal. So you could say, okay, I have 50,000, I'm going to put that down, but I have no net worth. So what you're looking for when you're building your team, again, this team can take you 2 years. You really want to find somebody that is hitting these 3 important commercial lending non-recourse requirements. First one is net worth. If you're going for $3 million deals, the loan amount is 2.5. You need to find somebody, hopefully one person, that will give you that. If you put 4 people on, you got to pay 4 people. Well, maybe those 4 people are doing the underwriting and all of that. You want to have it as tight and as slim as possible. So never commit to, oh, you'll be on my next deal. You just say, okay, thank you. I recognize you have 2.5. I'll keep that in mind. Second piece, liquidity. We need 10% liquidity 10% of the loan amount in liquidity. So what is liquidity? Well, it's cash. So cash that's sitting in a bank, could be a marketable security. So maybe it's stocks or bonds, but not wrapped in your 401k or your IRA. So it has to be an Apple stock, Google stock, Ford stock. That stands on its own. That has a value. Another example would be your cash value of your insurance policy. You took out a big one on your wife, right? There's a lot of value in that. That will be your liquidity. Now, another example, and a lot of people are starting to do this, is your HELOC on your personal home. You can put that into a savings account, say for 2 or 3 months, cost you $50, $100. You can put that $50 to $100, have the transaction pay you for that. And now you have the liquidity piece available. Maybe that's what you bring to the transaction. With the liquidity, 10%, that liquidity can go away the day it closes. So it's not something that needs to sit there. We call it post-close liquidity. It's really not really post-close, but it's not part of your down payment. And as a lender, we would really like to see, if we're saying we'll give you 75% loan to value, we're saying, okay, management company, the people that are managing this deal, I need 10% of that 25% down coming from the management team. And some people say, well, I don't have that. Maybe you can bolt on one of your investors and he can be on as a KP. So there's a lot of different ways to structure that. And then the last one, and this is where we're seeing some challenges, is we've got experience. We need to have experience. And Freddie used to say, well, you live in the neighborhood, you're having a third-party property manager, you have net worth and liquidity, but you have no experience. Well, I'm okay with that. You can do it. Back in October, they said, no more. So now you have to have, again, this is something you need to communicate with your investors who you're looking to jump on your deal is, I'm looking for 2 years, 2 years of experience, okay? And I need 3 to 5 transactions. That can come from one person, that can come from a group of people. So if you say, well, I don't have all that, now is the time to start asking people, especially in these networking groups on Zoom. You break out, one of your things should be, you should say is, I have net worth that I can help you with in the transaction. Now you're valuable to that syndicator. Okay.
Hey, Julie, I'm gonna jump in again right there, but I will also remind everybody that brokers know this just as well as Julie does. Okay, they know what it requires, what's required to get a commercial loan. So the broker, when you're first talking to them, they're most likely going to start asking you a bunch of questions to figure out if you've got this figured out already. Okay, mm-hmm. And if you don't have any idea that you need the liquidity requirements or net worth requirements, or you just plain don't have them, you're not going to get deal flow. You're not going to get the brokers calling you up and say, hey, I've got a new mm-hmm. deal. Okay, they're looking for the people who already have this, wrapped up in a nice little package and saying, hey, Mr. Broker, I'm looking for an apartment building. Here's my deal criteria. We have the mm-hmm. net worth, we have the liquidity, we have the experience required to mm-hmm. get a commercial loan. All right, that's what they're looking for. So, yep. Make sure you're getting all this stuff together before you start. I mean, like Julie said earlier, nugget number 1, talk with brokers outside the market you want to work in to get experience, talking to brokers and to learn. But, before you're going to get traction, you have to have this stuff, wrapped up in a nice little package with, mm-hmm. A little bow on top.
Yep, absolutely. And we always say, don't start underwriting because, unless you know where you're going, who is on your team, and what you're trying to achieve from a return standpoint, if you're underwriting, you could find yourself with a deal and now you're going to try and take that down. And if you make a mistake, those brokers will put you on the blacklist and they won't work with you. So you want to have this as professionally tightened up as Brian says, so that you really have, all you have in this is your are your relationships and the quality of the communication. I mean, it's your reputation that is on the line on every single transaction. So you want to come at this as strong as possible. Okay, so when we talk about agency loans, we are looking at for top markets. This is like San Diego, LA, Boston, Washington, DC, many like Jacksonville, Atlanta. These are top and standard markets. We're looking at 80% loan to value, 80%. And you can get a loan 5 years, 7 years, 10 years, and even 12 years. But if your investors say, I want to get in and get out, then you need to, and those are your investors that are going to give you the money, you need to be listening to your investors. You want to be coming to me and saying, I've got investors, I need to get in and out in 5 years. Then I put you in that loan. The other thing we need to understand when we're visiting and figuring out that you have this opportunity is, how long are you going to hold it? Maybe it's a 10-year loan that you're going to hold, but you're going to cash out your investors at year 5. So we're going to try and figure out the best way for you to get the right product for that criteria, that business plan. The other thing we have to know is maybe you're going to get a 5-year loan, but you really want to get out in 3 years. So we have to figure out, okay, what's the best way? How do we do this? And it's called prepayment penalty. Which way do we go? Do we go with a step down prepayment penalty, or do we do yield maintenance? So let's talk about yield maintenance first. It is the cheapest loan on 10 years. So a lot of people in the past have said, I'm going to go with a 10-year yield maintenance product. And 3 years ago, the interest rates were at 5%. And a lot of people jumped into them, and they jumped into them with very little equity or liquidity in the deal. Today, these people want out. Either they've run out of money or their business plan is done. And so they're saying, okay, I want to get out of this deal. Well, they have a yield maintenance penalty. And what that is basically when they got into this loan, the lender said, it's a securitized loan. They said, okay, we're going to sell this loan at 5%. For 5% for 10 years. So those investors are constantly going into their mailbox. Oh, I got my 5% every month. In year 5, you say, well, I'm done. Well, let's think about this. If the interest rate went down, they bought it at 5, and now they're going to go back to try and buy another property. They are going to have to take a loss. Yep. If it goes down to 4, we have to make them. They have to make up for the loss, right? So there's a prepayment penalty that you get slapped with if the rates go down. So I have to make up for that 4 to 5%. Now think about this. We are in a very low interest rate environment right now. We have the vaccine, we have COVID, we've got unemployment, we have a new president, we have, we don't like 1031, we don't like bonus depreciation. There's a huge push on inflation potentially. And so even in the last 3 weeks, we have seen the rates go from the 10-year treasury from 0.5 to 1.1. It's going up. So let's think about that. In this application, would you want to take out a yield maintenance? Because if it goes up, it's going to cost you nothing, because those investors that are at, let's see, today 3, and if the rate goes up to 4, they want to pay 4. So they want to get out of this loan, right? So yield maintenance in today's environment may be a good option. The second option.
I'm going to, give a second option, and I'll give you an example on that one.
Yeah. Second option is the step down prepayment. Now, if you're taking notes, this is the time to write a line across your piece of paper. And on top of the line, put 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You're going to take out a 10-year loan. And your business plan is, I'm going for 10 years. So I'm going to do a step down because I want to see how this works. Below the line, everybody got across, right? Below the line, on 1, put 5. Under 2, year 2, put 5. Under 3, put 4. Under 4, put 4. Do you see a pattern here? Okay, so on the bottom, it should say 5, 5, 4, 4, 3, 3, 2, 2, 1, 1. Yep, we all got that? Yes, can I see the heads? Yes. Jerome? Yeah, cool. Now your business plan says, I'm getting out in 10, but listen, I've done everything. I need to get out at 6. Jerome, if you would be so kind, how much is it going to cost us to get out in the 6th year? What's the prepayment penalty? Looking at, oh, you didn't write it down. Yeah.
It's gonna cost a lot.
No,
Is
it's
it
gonna be
3%?
3%. You see how it says 6, and I'm down below. It says 3. So
Wow.
now you can
Thanks,
sleep at
Sassy.
night. Thank you, Jerome. You're awesome.
Yeah.
I didn't mean to embarrass you. So now you know that you can now size that deal with 3%. So maybe you get the cheapest loan, you get this prepayment penalty, gives you a little more flexibility. Now, what we're seeing right now, going back to that example, 5 years ago, people got into this yield maintenance. If it went up, they'd be fine. Interest rates down. We're in the lowest interest rate, 3%. It's costing people millions of dollars to get out of these loans. So what you're seeing is assumptions. And the reasons why they're assumable, well, why they're having assumptions are available now is because it's costing them $1 million to get out of that loan. They maybe would have been better if they took a step down. Now go ahead, Brian.
Yeah, I was going to give an example of that. The acquisition that we just completed, it was a 167 unit in Augusta, Georgia. The seller had a yield maintenance loan, and he would have had to pay millions of dollars to get out of that loan. Okay, 5.1% interest rate. So it is not a nice loan, especially when you can get a brand new one for 3.5-ish% right now. But what that did for us is we think that property is worth somewhere around $9 million. Because of that ugly loan that he had to have somebody assume, we paid 7.1. All right. So from a future seller standpoint, when you get into this, just realize that if you have that really ugly interest rate on an assumable loan and a large prepayment penalty, you're going to take a hit. Either you're going to pay the penalty or you're going to pay for it in price or terms when you sell it. All right. If you're a buyer and somebody has one of those, there's opportunities to negotiate.
And again, it could be that yield maintenance in an environment that's very low, it would not necessarily have as much impact in this environment today as it would have if I were buying 3 years ago and what the impact is today. So think about that. It is the cheapest loan is yield maintenance. Now, the last part of this, I have 10 minutes. The last part of this, or one of the other things that's different than bank financing on a on a non-recourse agency, Fannie and Freddie, owned by the government, right, is interest only. And on a loan that is 5 years, typically we can give you 1 year. On 7 year, we can give you 2. And on a 10 year, we can give you 3. Now, we can always give you more. Somebody says in Slack, says, oh, I got 5 years interest only. Well, that's great. That's really good. But when you think about it, the rate was probably low because they put in 35 or 40% down. So the more money you put into these deals, the more flexibility that a lender will have. But the syndication model is this: long-term debt, little money down. So if you want to do larger downs, that's fine. It will affect your returns. So interest only is another really cool deal. And you can see how, you're taking in gobs of money and you're only paying out interest. And you do that for 3 years. You can do your rehab. You can bring extra money into the rehab as well. Oh, I do have one last thing. I told you there was one last thing, but I have one last thing. On these agency loans, in COVID, we now have this COVID reserves. And it started out with a lot of different pieces, but now we're really scaled down. So on Freddie, and you'll need to know this, again, write this down. Freddie, when you're underwriting, Freddie is going to be 12 months of principal and interest reserves. That will be returned to you in 12 months. All right. There are some other stipulations, but for the most part, it's 12 months. So when you're underwriting it, make sure. Now you can use that. Some people are saying, I'm not starting the rehab until year 2 when this gets returned. So that's an option as well. Or you can capital raise more money and then return it in year 2 to your investors, this COVID reserves. On Fannie, you're talking about 18 months on the small balance. So small balance on Fannie is going to be 1 million to 6. That's going to be 18 months. Above the 6, you're at 12 months. So it's something to consider when you're underwriting. I really think that Freddie has a great tool, and you can really get things done. You got 12 months. You can get it done fixed, and you know, those go up to 7.5 million. So everything, you know, that we're looking at can pretty much fit into that number, into that product rather.
So let's look at that. I mean, the reserves a little more carefully, because that could make or break deals for some people. Let's say you're doing a large value add, you know, and you have to raise a lot of money for it, but you're not going to spend that money over, you know, in the next 12 months, right? You're not going to spend that money because you have people in the apartments and you have to wait till people move out. And so let's say you have a time phase approach where you're spending the bulk of that money in 2 to 3. Can you put that money as your reserves? And what would you think about that as a strategy?
Yeah, so that money would be considered, well, you could, basically what you would do is you would capital raise for that down payment, right, for the reserve requirements, and then you'd capital raise the rest of it, right? So you have 130 in your reserves, and you're going to bring in another 500. You're going to, maybe some of that, you know, you will sit in the bank, and then you'll use maybe that 500, and then the rest of the 130 will be released to you in year 2. So it'll cost you less money, right? If you bring some in without capital raising. Yeah.
Yeah. Okay. All right. Let's see. Did
So
we?
That was a quick overview. I could go on. I love what I do.
Okay. Just looking down the notes, making sure we hit all the wickets. I think we did, actually. So, all right. Question. So how about this? Questions. And let's do this. If you want to, just take your microphone off mute and ask. If you're a little shy or it's noisy where you're at, go ahead and drop it in the comment box.
Hi, I have a question. This is Sassy.
Hi, Sassy.
Hi. Is it more beneficial to get a loan through an agency like Fannie or Freddie versus going to a bank?
Well, you know, in commercial lending, we always say, well, it depends. It depends on what the strategy is. I would tell you this, the gold standard is agency. It is expensive, but it allows you to buy and be in a transaction Monday through Friday. There are no restraints on using your capital or buying a bunch of deals. Whereas bank lending is going to have some restraints. It's going to have some limitations. But if your business plan and you don't want to have to capital raise for these COVID reserves, then a bank financing is a good idea. It really just depends. If you don't have net worth and liquidity, then you would go with the bank.
And Sassy, this would be a great question. You know, once you have a deal that you're looking at. Oh, there was one thing, Julie, that I do want you to answer. But once you have a deal that you're looking at, you can bring it to someone like Julie and say, hey, Julie, here's our business plan. Here's the deal we're looking at. Guide me. Tell me which loan we need to fits my business plan the best.
Okay,
Yeah.
but it would still apply, like the points that you gave, you know, the property 90 to 90 for 90, the net worth liquidity, that still applies even if you're going to an agency.
That's what is required for agency.
Okay.
Those requirements are not requirements for bank. A bank wants to know that they're going to get paid back in a short amount of time. So they're going to be looking at your credit. They're going to be looking at the deal itself, and they're going to make sure that the people that are in charge have experience. They really are laser focused on the people that are in the deal.
Okay.
All right. So
Not
Julie,
so much as the performance of the asset, which is where the agency really spends a lot of time understanding how that deal, how that property is performing, and then they can make decisions on that.
okay. So Julie, so here's a question that I do want you to answer. You have a bunch of budding, want to be, it's aspiring, whatever the correct word is. I used probably a couple words that probably weren't the best, but aspiring syndicators here.
Yeah.
They get a deal. They think they're going to put an offer in. What should they do before coming to talk to you?
Yes.
What should they have in place
So,
before that?
yeah. So we're going to want to see your personal financial statement. We're going to want to see a schedule of real estate owned, and we're going to want to see a resume. So that needs to come from everybody that's on the deal. Now, you may say, I found this deal. I don't have a sponsor. That's okay, because that's the great thing about Old Capital is we have the relationships that we can help you bring. Most brokers or banks will say, that's not what I do, but Old Capital is different. We really help you put the team together if you need it. And we can also help encourage people to be LPs on your deal. So there are ways you may say, well, I don't have everything in place, and that's okay. What I really want from you, if you can't get me that personal financial statement and that stuff, I want to see a T12 and I want to see a rent roll. And if we're talking about something that's current today, I want to see December. December, the previous month, is going to come out on the 15th of the next month. So we're in January, it's past the 15th. I want to see December numbers. And so you go to the broker, hey, this July is not going to work for my lender. Why not? Well, this is how I say it. Garbage in, garbage out. Because what happened back 7, 8, 10 months ago is not gonna be helpful for me to underwrite. The second piece is your rent roll. You're gonna need to get me January's rent roll. Now, sometimes you can't, but you try and get as close to effectively the date today as possible. So make sure that, when you get the property, the OM and such, look at that. And you know what? You'll look like a superstar talking to the broker. Oh, I just noticed, can I get some updated financials on this? I want to make sure that I get the right, because remember, we are sizing it over the year, how it performed. We're not going into the future. We're only looking at a snapshot of it. And we'll look at T3. So the last 3 months is really how we'll consider where the income comes in, and T12 on the expenses. So those two items are really important if we're moving ahead or wanting to figure out how much can I really be buying a property for. Having that personal financial statement and a schedule of real estate, you can Google them, and a resume would say to us, I am preparing my team to get together so that we're not looking at $25 million deals when I can only afford a $5 million deal. Now, you will hear people say, if you find a deal, people will jump on it. You know what? Sometimes they will, but sometimes, again, you want to play. You don't want to be running around and making people think you can do it, and then you cannot. That's a bad deal.
It's going to ruin your reputation before you
Ruins
even
your
get one.
reputation.
Hey, Julie, one question in the chat room that definitely pertains to what we're talking about right now. Talking about experience, where's the line in the sand for experience? Do you have,
Okay.
I think
Yeah.
I know the answer to this, but I just want to hear you say it. But
Well, we can be flexible to a
Yeah.
certain extent, right? I mean, if you're doing 50 single family homes and you only have single family residential loans, but you're going for a 50 unit multifamily, that we could use. Okay, that says, okay, they have experience. But if you have bank loans and you only have bank loans on 2 5-unit buildings and you're going for a 100-unit building, not so much, right? So kind of like kind. That's Freddie's family. That's the Freddie view. On Fannie, they're going to say, no, I need agency debt. I need to know that somebody has 3 to 5 transactions using agency.
And transaction means you have signed on the loan, not just being a member of the GP, but you have signed
Not being
on
an
the loan.
LP, not
Yep.
being an LP.
Yep.
LP is great, but it doesn't build your experience towards being a GP.
Yeah.
But again, as I started this conversation, everybody should be a GP. I'm sorry, everyone should be an LP. Really important.
Yep. All right, let's see. What role would you play in a loan assumption, if any?
Myself, thank you. That's a
Yep.
great question. Remember, the jockey, which is considered the bank, has the loan. They are going to change they have the horse, right? They're going to change the jockey. But that jockey has to qualify. It's not like, oh, well, I want to buy this, so I can get in. You still have to have net worth liquidity. And in many cases, if this is your first or second or third transaction, things can go wrong. And you want someone to work on your behalf to stand up to the bank and say, that's not okay, that's not right, or wait, let me help you with this. I've been working with a group for 2 years. We've underwritten 250, and they got into an assumption. And they said, oh, we don't need you. And we talked to them and said, you don't want to do this alone. And at the end of the day, they were so thankful. Now, we're only going to charge you 0.5% for that, but you really do want someone. I mean, the paperwork is, it's a lot of work. Brian, you can probably attest to that. It's a lot. So it helps guide you and hold your hand and make a smooth transaction.
All right. Okay. So next question regarding 90% occupancy, and the 90% occupancy was the rule for agency debt. The question was, what lending product would you recommend for something like that?
For somebody that has less than 90?
Less than 90% occupancy, maybe a major
Yep.
rehab type product.
Yeah. So we didn't get to a bridge loan. A bridge loan is a great option. You could go with bank financing. Sometimes their loans are expensive on bridge or on a they call it a construction loan. You could go hard money, or you could go private money, or you can do a non-recourse bridge. And so bridge is probably going to be around 5 when everybody else is at 3.5, right? So it's a little bit more expensive, but it's 3 years of interest only. Interest only, 3 years. You could do your rehab. You've got income coming in. You can get out in 3 years, or you can take an additional extension, 1 year, and then, ooh, I need another one. So you can get actually up to 5 years on a bridge loan. So great alternative. And what we're seeing on some of these, really tight markets is that the pricing, just like in Southern California, I can't get 80% because of the pricing. People are using a bridge when we can only get 65 on agency. This might be an option for you. So bridge, non-recourse bridge. I'll tell you this, if it's under 5 million, it's a challenge to get done. It's not like, oh, I only need 500,000. You really do on a bridge, non-recourse, 5 million. I've done 3 million, but where it really makes sense and we can get it done pretty quickly is at 5 million and above.
All right, rolling through the questions again. Contact information, I dropped that in again, brought it to the bottom. I think it's in there 3 or 4 times. We had a couple people ask for it. Okay, so as far as the, when people are talking to you for the first time, the question is, what kind of research or additional information are you looking for on a person's resume? I mean, what is good things to have on there, and what are things that let's just stop there. What are good things to have on
Well, I think it's really helpful to say I'm a LP on this.
there? Mhm.
I've got education of 2 years, 2,000 hours. I am in a mastermind. I have purchased single family. I own with someone in a JV deal like Jerome, and you own that. There you go.
Yep.
Quarterback.
Boom.
Yeah. So that kind of stuff. You know what? If you're an engineer and you're really good with numbers, that stuff is helpful. I'm a babysitter, not so much. Things where you can utilize. Remember, you've been a single family person and you've been a landlord. That's going to be helpful to do due diligence. So you know the process. So it just depends. You need to know where your strengths are. What do you have? What do I need? And put that down on paper. It's nice to kind of take some time to think about that.
Okay. So, and I'm going to ask one more question, and sorry, this is going to be the final question, but along the same lines, I've seen a lot of websites and a lot of people who say, my strategic advisor is Joe Fairless, or my strategic advisor is Michael Blanc, or my strategic advisor is pick a big guru. Does that help?
You have to ask them first, because you know what, that's something that you just don't want to put on there. I've heard people doing that without doing it. I think there is some help. If you can get some coaching is great, and I would put that down. Putting down your lender, that you have a personal relationship, that is helpful. Putting down your property manager is helpful. All of those people, you should have a relationship before you get into a transaction.
Yeah. All right. Sounds good. Well, hey, thank you so much for sharing all of that knowledge and wisdom with us. Very much appreciated. We are recording this, so we will, eventually send a link out to everybody who registered. So when you registered for the event, you had to pay an email address to register for the event. So I will send the recording out to everybody who registered. But that said, we are going to switch to the virtual networking portion. And, right now we have about 50. I'm going to wait for about 2 minutes to start the networking, because people drop like fly. I mean, about half the people by experience are going to drop. So while we're waiting for that, anybody else have any shameless plugs?
Can I just say one thing? Because I said I was going to give you 3 words of wisdom. The first one was practice in the markets that you have no anticipation in. The second one I said is tell the seller to keep his foot on the gas. The third one, hard to do, but really, if you can structure it, do not close in December. Really tough. People don't pay their rents. Your income will drop, and it's really tough to. Sometimes you have to retrade it. We don't like to retrade because people are not paying their rents. So if at all possible, do it before December. And
lenders go on holidays. We found, we tried to close on something last December, and we had a hard time getting people because it was like, hey, so-and-so's on vacation. And it happens. So that one got extended quite a bit. So, all right. And your investors will want to close at the end of the year. So they want to have a, sense of security that you're going to close. And that has tax implications too. If you close before the end of the year, your depreciation and your bonus depreciation, you can close on the 31st of December and still take a full year's worth of bonus depreciation in that tax year, which is big for a lot of investors. For some investors, it doesn't matter, but for a lot of investors, they are looking for, a passive loss through a cost segregation analysis or whatever. But that was the subject of several months ago's meetup, but here we go. All right. So we are going to break everybody up into breakout rooms right now.